what's going on like with her hair.
Yeah.
I was kind of fixated on her hair. The
hair drew him in.
Welcome back to your favorite podcast on the planet, on the universe, around the world. Realty Talk podcast. We talk all things real estate, single family, multifamily, commercial, lending, purchase, investment, buy side. We have a really special guest today. I'm excited. So I'm your host, Paul Hansen. We've got the queen of the closing table, Suzanne, and we have Sal Abolohsseini.
Nailed it.
Yes, I got it.
Fun fact, we're married. So for those of you that don't know. So what's really great, I think, with all of our partnerships and really cool and such a nice addition is that we're all integrated in the business somehow.
Right.
And so, I own Innovate Realty, run Innovate Realty. Paul takes primary on Bye Bye House. Sal takes the lead on Streamline HOME Lending. So that's his company. But we all work together in some capacity. And today we just kind of wanted to talk through. I know there's a lot of chatter around where rates are right now. We've been talking NAR changes, how that affects affordability for buyers, but I know you've got some questions before we dive into that.
I think in a previous episode, we actually talked about this. So generally, our weekly updates are always just straight into business. And this is the way that this began, which is, okay, we want to talk about interest rates and NAR, and let's get right into the meat and potatoes. But before we do that, personally, I don't even know some of these questions, but how did you guys meet? How long have you been married?
We got to hear from you. It can't always be me.
Okay. Yeah.
So you're the guest. You're the guest.
If you know the answer.
Yeah. No, for sure. No, it's actually a good story because, at the time I remember I went out the night before and I remember just trying to stay home. I was exhausted. I was tired, and I got a buddy who was going out. Well, our group of buddies were all going out, and I remember them calling me, "Hey, we're coming to your place," because I had a place, so mine was like the pre-party spot or after party wife. So they're calling me. We're on our way. I'm like, "Don't come over. I'm tired. I'm staying home." And they said, "Just one drink." So of course they convinced me to stop by to have a drink. And then of course now I'm in their car. We're heading out.
Yeah. So
we head out, and then from there I remember Suzanne's friend had a wig on, and it was a big wig. And I just remember she standing out because it's huge wig, and my buddy was just like, "What's going on like with her hair?"
Yeah.
I was kind of fixated on her hair.
The hair drew him in.
Is that like your friend would always wear wigs, or?
We would, we should have a wig talk one day. But yes, she would periodically wear wigs, but she has beautiful long curly hair.
Okay. So
you don't always want to sometimes you want to try something new, but you don't want to cut your beautiful long curly hair. So throw a wig on it and, try something new.
I mean, really, that's how it all kind of started. He came over, started talking with her, and then I think I was kind of like wingman, right?
Well, so he all of a sudden, he's like, "Drinks on me," and he's ordering drinks. And
he doesn't have a job, he's in school.
This is your friend.
Yeah.
And then he's like, "Hey, Sal, can
Exactly.
So when the bill comes, like, "Hey, heads up.
So
I'm in school."
Poor Sal's like, "Okay, I'll get the bill." Like, not interested in that situation at all.
I'm learning a lot. So when we go out, just ask for Streamline HOME Lending.
Credit card.
I will see if you have a school ID. I'll take a look, and otherwise we could fund it.
Yeah.
So I think we started talking because his friend was kind of infatuated, I would say, with my friend. And so it was just like, we were both like...
or the wig?
I think it was the wig.
Man, might have been the wig. Yeah. Might have been the wig.
Did they end up dating?
No.
Nothing
ever. But we did.
Yeah, no.
9 months later. Sal is really great at lead follow-up.
Yes.
So followed up with me for a very long time.
Yeah.
And
Several months.
Yeah, 9 months
Like, literally.
to be exact.
Yeah, we actually did not go on a date until like 9 months later.
Really?
Yeah, I think I gave up twice, and
Wow.
I got like follow up. I remember at one point like, that's it, I'm done.
Yeah.
And then she actually followed up, and then I was like, okay, and then but at some point we were actually able to hang out.
Yeah.
How long have you guys been together?
So now it's been
So that was 2012. That was the beginning of 2012.
Yeah.
So, yeah. It's been
12 years?
Yeah.
quite some time,
Wow.
but
Time flies.
Have you had
married 2017.
Oh, okay. And have you had Streamline Home Lending through that whole phase?
No, so at the time I was working for Loan Depot, a retail direct lender. So 5 years on my own now.
Oh, cool.
So at the time, yeah.
Yeah, that was part of the story that I didn't tell as well. Is we weren't really out. You know, we were had a marketing company and doing some things, and so our interest was like networking with people. And so my friend asked his friend, do you own a business? You know, she's thinking this is like could be a networking opportunity.
Oh, you and your friend were working together.
Yes.
Got it.
And his answer was, I don't own a business, but he does. And Sal gave me his Loan Depot business card. And
Yeah, I'm the owner
like,
of Loan Depot.
He owns Loan Depot. Interesting.
This is a good client. Yeah. You start Streamline Home Lending in 2017? No, 2020. 2019.
So 2019 when I went out on my own. And it's actually a good story I'll touch on. So I was with Loan Depot on the retail side for 9 years.
Wow.
And so...
But how many years in the industry?
So I've been in the industry for 20 years now.
Oh, wow.
And so...
So you started when you were 12.
And yeah, pretty much.
It feels like it.
Yeah, I was 20 years old when I started the industry. So, which is, pretty young for, jumping at that time, especially 20 years ago. I think now we're seeing a younger generation coming into the industry. By the time I remember by far being the youngest.
Yeah.
And it was good. And, but, I got to a point in my career where it was like, I remember I wanted to get out, do it on my own.
Yeah.
And when that time came, I remember Loan Depot didn't want to let me go. And they kind of said, hey, we want, they bought iMortgage, a big purchase company nationwide. And they said, let's have you meet some of the branches, some of the top companies, and kind of show you what we could do on the purchase side. Because I let them know, like, I want to focus on purchases. That was like my big thing.
And I would say Loan Depot historically, before iMortgage, they were primarily refi.
Yeah, like 99.9%. They only touch refis. And matter of fact, when they did purchase loans, they really didn't understand it. Most of the loan officers, I would say. Matter of fact, when the president or someone in the company had a personal referral, they actually reached out to me to do the purchase loans. So I did quite a bit of purchase loans for the company, and I just knew that's something that I really, really enjoy, is getting families into homes.
Yeah.
So I wanted to focus on that, but do it on my own, because I knew with, a company like Loan Depot, they're focusing on like, conventional, FHA, VA, not some of the out-of-box stuff. Guidelines might be a little strict. And I'm like, all right, so I want to have all products. I want to be able to make sure I get every single deal done. Not like, here's my box, do you fit in it, type of thing.
Yeah.
So, but I was, even though I had a plan, I was like, what, been here for a long time, respect everyone. I want to take a look at everything and not come in there like, no, there's not a chance. I actually want to look at it open-minded and give it a shot. So I actually met them a few more times afterwards. But in the end, banking on myself, I felt was like the best decision, because, man, there's been so many scenarios. I'm like, yeah, there's no chance that deal would have got done. Yeah. If it wasn't for, our other investors to get really creative and find solution. I mean, I feel like Homeland we just closed on is a great example.
Yeah, I was just going to say that we've gone through a couple of transactions where, I mean, without getting into the gory details, we look at it on paper and it's like, this is going to be difficult, right?
Right.
And you guys always get.
So we're like, Sal.
Yeah.
Yeah.
There you go.
Yeah. And I think that's what's kind of great about like the full circle of the scenario where, Streamline will look at your guys' deals that are coming in and like bring it up Homeland. Like we took a look at it on a cross qualification to make sure there's a loan there with the other lender, and we take a look at it and like, here's our concern. We
Yeah.
don't feel like we don't have a home for it. Jumbo at 5% down, and this is our concern. And we understand that the lender was super confident over there. No, the deals are going to get done, so you guys accept it. And a couple weeks later, all of a sudden, there's a struggle.
Yeah.
So what you're saying is you're the guy to call for these really hard, ugly, difficult deals?
Yes.
Is that what you're raising your hand for?
I would say that for the easy and the difficult, just bring them all over.
Okay,
Bring
all
everything,
deals.
yeah.
All
Yeah.
deals. Got it.
Yeah,
okay.
if you want the deal done.
Okay.
That's awesome. So your business structure, essentially, you like all deals. You like the complex ones, but you like the easy ones. What's today like? I mean, we're, beginning of August, mid-August, 2024. I imagine, sorry to rewind a little bit before I ask that question. Launching in 2019, probably somewhat stressful. The market's good, but it's not like on fire like 2021.
Right.
But I imagine getting through 2019 and 2020, I guess 2020 was probably terrifying.
Initially.
Because of COVID.
I would say the start of it, it was definitely a scary point when you get into it. It's like, oh, okay.
Yeah.
Is this the new norm? This is a lot longer than they said. They said 2 weeks.
Yeah.
Now it's been 2 months, right?
Yeah.
So there's always.
Were you considered essential as a
Oh,
lender?
yeah.
Were you like
essential
still?
business?
Yeah.
Man,
I
we?
think you were. I know real estate agents were. So
I don't
think
know if investors were.
No, I don't think
so.
that's essential.
No.
But
Yeah.
But you start this venture, right? And you've got people on payroll, and you've got a business where you're putting food on the table for people, and then COVID hits, and it ends up. I imagine. I don't know. You tell the story. Was it crazy stressful?
I mean, being in the industry for 20 years, seeing the market in 2008, I felt that I was very lucky to join the industry prior to that, and very fortunate to kind of see the really tough times. And for myself, I never left the industry. I remember all my friends that were in it, all were out of the industry, change industries, doing something completely different.
Yeah.
But they were definitely not a loan officer doing loans. And here I am still, doing it, but not just doing it, I was actually still successful. Not that I'm killing it in 2009 and 10, right? But I was still successful. I was still able to afford my bills. And I was like, oh, this is a career. At first I wasn't sure, is this a phase? How many years? Like, what's the game plan? What am I saving up for? What's the game plan? And then I come to realize, like, no, this is a career. This is something I actually really enjoy doing. And then touching on purchases, that felt even better than refinancing.
Yeah.
So just kind of getting families and people into homes obviously feels amazing.
Yep.
So when 2020 happened, I already had my nest egg. I already knew, like, hey, having a business, I need to have funds and be ready to be prepared for the good and tough times.
Yep.
Nobody imagined COVID coming in and pausing things. That's a very difficult, stressful time, but I was prepared to get through the tough times, so I knew it was going to be okay. I was able to have meetings, everyone be calm, we have a game plan, and talk about little things.
I think when you live through the 2008, because I was also in lending in 2008, and that is when I left lending in 2008, or 2009. So I think if you make it through that point, you're like, nah, nothing's going to be that bad, because it was pretty brutal.
Yeah. And so, and I don't want to say it was short-lived, but 2008, that hangover, if you will, definitely lasted a lot longer for things to pick up compared to what we felt in 2020.
Yeah.
Because then all of a sudden, a couple quarters later, you started seeing people were like, oh, this is kind of the new norm. COVID is not going away.
Yeah.
Start printing
let's
money,
start
buying things.
Yeah.
And then we started seeing rates dropping, which created a refinance frenzy, if you will.
So, I'm super fascinated by rates and the market, and if you're okay to talk a little bit about that now, I remember vividly growing up. My dad told me the first house he bought, he had like a 17% interest rate.
Mm-hmm.
That's in the 70s, right? After COVID or during COVID, 21, 22, rates go all the way down to like, I guess the lowest they were is like 2.25 or 2.5.
Yeah, so 30-year fixed, 2.25, 15-year fixed, like 1.8%.
It's like free money,
Yeah.
basically,
Really is.
essentially.
Yeah.
And where we're at today, I guess 3 weeks ago we were just north of 7%.
Right.
And then it's kind of been ticking back. Last Friday they got down below 6.5, and we're kind of right around that now. Is that right?
Yeah, I mean, as of today, 6.35%.
Wow.
Interest rates on Friday were 0.5% higher. They dropped 0.5% in one day.
Yeah.
So as soon as that unemployment rate came out, we're like, oh, okay.
Yeah.
So then we just saw the interest rates drop down, the bond drop down. So I think in our near future, we're just going to see the interest rates trickle down a little bit.
Yeah, historically, the math that I understand is that a 30-year fixed mortgage generally pivots from the 10-year treasury rate, right? And so by 175 basis points. So if the 10-year treasury is at 2%, then we should see a 3.75%, 30-year fixed mortgage. And the last year and a half, we've seen something closer to like 200 or 225 or at one point 250 basis points above the 10-year. And I think the 10-year topped out just shy of 5%.
Right. And I feel that's one thing that majority of consumers are definitely not aware is that they do not need to wait for the Fed to reduce the rate. This has already taken place. Right. So to me right now, if I was like a first-time home buyer, like I would try to purchase a home prior to that Fed meeting, because to me that's when the rest of the world's going to probably know rates have come down. And guess what? Open houses are going to start picking up. Now that's your competition, really, right? Yeah. So it's like you want to try to buy the home before all that competition comes, because ultimately you're probably going to pay more for the property.
Yeah, I don't know if it's an unpopular opinion, and I think it might offend some people, not in this room, but just like generally. What I'm really afraid about right now is that, our last major recession in 2008, 2009, was tied to the mortgage-backed security and failure of underwriting, and lenders were doing 100%, and so we saw those foreclosures and banks failed, and that's ultimately what sent the stock market into a major recession, and I guess my fear is trying to figure out how to say this and not be offensive, but do you think the average American consumer will not correlate those two? Because there's a fair argument right now that demand is still very high. Mm-hmm. A 6 or a 7% interest rate on your 30-year fixed mortgage is not that expensive. Mm-hmm. We just haven't. People are really still hung over from a 2.5 or a 3% mortgage.
Right.
Pricing in most markets that we operate in hasn't really corrected, so affordability is tough. Mm-hmm. But I mean, if the stock market sees a major decline, there is an argument that real estate stays flat or even still goes up. Do you think that the average American consumer will have confidence to buy when they see that news around the stock market?
I would say that it's always going to be scary. When you purchase a home, it is the most expensive investment of their life, majority of consumers. So there's always going to be that, being nervous, being scared, and it's absolutely understandable. And I would say that, maybe majority won't feel great, may not have that 100% confidence versus purchasing something that's a lot cheaper. Right. But, ultimately, knowing the way the loans are regulated now, you should definitely have the confidence, because we're over-regulated. That 100% financing with no verification of income, no credit score required, et cetera. Yeah. That's long gone. Now that we're not just regulated, overly regulated, everyone has to have, good credit, got to have a decent down payment. They got to have a whole healthy amount of income to qualify. Yeah, and that DTI is they're like very strict on that. So if whatever it is you're qualifying for is going to be affordable.
We have a fair number of people that listen to the podcast that probably have never purchased a home before. Can you talk a little bit more? Because we've thrown out a lot of terminology.
Right.
So DTI and like if you've never bought a house before, what does that process look like?
So basically, let's just talk about DTI really fast. DTI is your debt to income ratio. Yeah. So essentially it's your income versus your obligation for housing. And another thing they'll also look at is not just your housing, but total expenses, such as credit cards, student loans, auto loans, etc. So they look at everything, both sides of things. And there's rules. And the rule of thumb, I would just like to say, use 50%. So if your income is $5,000 a month, then that means that your mortgage payment essentially cannot be over $2,500.
And is that income gross or is it net of taxes?
So it's gross, but if you're self-employed, then if you have write-offs, they're going to use your adjusted gross income.
Yeah.
But if you're W-2'd, they will use your gross versus your net. To answer your question there.
Yeah.
And so the consumer, when they're getting qualified, they're going to gather, their pay stubs, their W-2s. If they have a down payment, they gather their bank statements and essentially connect with their lender, show them, have them calculate the income, take a look at credit, and the loan officer's job is to determine what they feel is what they can qualify for and put them into the right program and show them exactly what they can be approved for, what they felt that they should be comfortable paying per month, and all that kind of good stuff.
But rates, related to that, rates make a massive impact in that whole equation, right? Because, in the last 5 business days or 7 business days, we've seen basically, if you're buying a house with a $5,000 payment a week ago, it now is 20% cheaper essentially with the rate reduction, right?
So our team right now we're kind of just scrambling right now because we want to update all of the clients of what's been happening on the interest rates because that has increased their purchase power.
Right.
A lot of our approvals, we're showing them their max budget where they can go up to.
Yep.
And then we also want to know exactly what they feel comfortable paying and then showing them that as well.
Yep.
So they just have a couple of options to kind of gauge, where they can buy, what they feel comfortable buying to see what kind of home they can purchase. But when that increases, we want to show them that. We don't want them not to be educated and find out, in September when the feds cut the rates and there's more news on it, like, oh, hey, Streamline, can I increase my purchase power? Like, I want them to know now for reasons that we discussed before.
Yeah, I think that's an important point because, we look at it from a savings perspective, but it's also, an affordability thing. Now they can actually get maybe into a different home, even a different caliber of home based off of that lower interest rate.
Or previously, if they just weren't able to qualify to buy something in the area they live in.
Now
they might,
Right, absolutely.
Yeah.
Because go ahead.
I was just going to say, can you walk us through what like a rate buy down would be or other programs that might adjust the payment or create some affordability for a buyer today?
A lot of consumers will hear something called points. And points essentially is something that the buyer is going to pay to buy down the interest rate. So if the client's qualifying for a 6.99% interest rate and maybe they could obtain 6.5% by paying 2 points. And 2 points is 2% of the loan amount. So, and that's something the buyer can come out of pocket for, or that's something that they can request the seller to pay for with a seller credit.
So they could negotiate that into the deal.
Exactly. And this is something that we've done quite a bit on since the interest rate's been going up and help bring in affordability is buying down the interest rate. One thing that was really neat and created a lot of buzz was a temporary rate buy down. And what that basically means is that we give the client a fixed rate for 30 years, but we discount the note rate for the first year or the first 2 years. So for an example, we do a 2-in-1 buy down. And so the interest rate, instead of being 6.99, now it's actually going to be 4.99 for that first year. Then it goes to 5.99 for the second year. And then it goes to the note rate for the remainder of the life of the loan. The client is still qualified on the note rate. So there's not going to be a situation with affordability
so your
going
DTI
into.
is...
Exactly.
Got it.
So again, like we're regulated, and they're making sure buyers are still not qualified on that lower teaser rate, right? They're qualified on the higher rate, but it helps them bring that affordability. Because at the end of the day, we all know that interest rates are high because of inflation, and inflation's not forever. Interest rates are going to come down, so it allows them to have that affordability to simply refinance to that lower interest rate permanently.
And what's cool is right now with interest rates, I think, you said it the other day to all of our agents here, but what you do a 2-1 buy down right now, you could potentially get a rate at 3.9% right now. That's amazing. So,
absolutely.
So for buyers, I think the message is, inventory's still low, but there aren't a lot of buyers necessarily in the market. I think not all buyers have this information yet.
Right.
And it's important that they do make a move now before it turns into a 2021 situation with multiple offers. If interest rates drop into, the fives or low fives, the gloves are off. Yeah.
Yeah.
Yeah, I agree with that.
I think it's kind of, one of the takeaways that I'm having from this conversation, and we touched on in the last episode, we interviewed Franco.
Agent F.
Agent F. Yeah, one of our top producing agents. But I guess for me, if you're a listener that's never purchased a home before, it's not really just about selecting a great agent. It's really about selecting a great lender that communicates really well with that agent and the selling agent, because that trifecta, that relationship, cool minds will find a way to get a deal done.
Absolutely.
So yeah, I have a ton of confidence in your business. We've done a lot of loans with you guys, and if you're on the sideline, I know a great agent and I know a great lender.
I'll put a link in the comments now.
Yeah, 100%.
Yeah, I think it's a good point, because I think so many times, especially in escrow, I, as an agent, I always took it upon myself to, kind of manage that transaction and make sure that everything goes smoothly. But there's a huge part of it, which is your buyer's lender. And sometimes, there are so many lenders out there, honestly. And like you touched on with Loan Depot. Loan Depot's a great company. They've done a ton of business, but they really focused on refis. Right. So, having someone with experience through the purchase transaction is, it makes such a difference in closing on time. And it's just night and day in the experience too for the consumer. I think that's, such a huge part of it is making sure that when you buy a house, you feel good when it closes. You don't feel like, whew, that was stressful. I think, at Innovate, I think that's one thing that we really try and focus on. I know you do too, is it's about a positive experience.
Absolutely.
So I'd love to pick your brain just a little bit on, and I know some of this is kind of opaque for all of us because things are changing daily, but we're at the beginning of August now, and mid-August we have all these NAR changes. And so we could touch on those briefly, but I'm super intrigued to understand what that looks like from a lender's perspective, because the changes that I think are very real in all of our businesses are that if you are now listing to sell a property, our understanding today is that there's a place on the MLS where you're going to be able to disclose what you're offering in terms of a seller concession. And then if you're an agent or if you're a buyer, before you get into escrow, you're going to have to, actually before you view the property, you're going to have to consummate an agreement of, hey, I'm a buyer and I'm willing to pay my buyer's agent X amount of dollars regardless if the seller is contributing anything. So how is that going to change this whole dynamic of qualifying for the property? Because previously, or the way it functions today, the seller's really paying the buyer's agent commission, but that's really getting wrapped into the purchase price of the home and it's getting financed, right?
Right.
And so under these new changes, is it possible that a buyer is going to be qualifying for less or buying a small, a lower valued house to be able to purchase in the event that the seller isn't contributing that, that credit or that commission?
Well, it comes down to me, is the property or the seller. Because if the seller is not willing to play ball with the buyer agent to cover some of their commission, if they're a first-time home buyer and they only have 3% down payment, they don't have enough money to also to pay for their buyer agent fee, then that property may not be meant for them, unfortunately.
Right. Or, that agent and that seller might lose out on a deal because they're not, they're not putting that forward. So
it's interesting.
So it's, I feel like we're going to see where it goes, but I think some sellers are going to learn fast that probably need to keep it like it was before. It just now that it's disclosed, right? There's a number on the contract.
Right.
So I feel like maybe there's essentially I just feel like you guys are getting regulated, and like we were in 2008 and 9, like you guys are kind of feeling what we felt before. So it's not a bad thing. It just, it's a change, right? So you got to adjust and pivot to it. And I know it's going to be more work, more discussing and all that. But, essentially I feel that the seller can still pay if they want to have, all buyers be available to them, not just the ones that are selling that have the money because of their equity and how much money they've made in the last year, 5 years. They also want the first-time home buyers, et cetera, to bid against their home as well. Then they probably need to play ball a little bit.
Yeah. Yeah. And so what I hear you saying is that if the seller is contributing that concession, then it's going to be pretty seamless and it will flow just like it was before. In the event a seller's not offering a concession, let's say I'm a buyer, I hired Innovate, and I said, hey, I'll pay 2.5% of this $1 million purchase, right? So I'm on the line for a $25,000 payment to my agent. Let's say that the seller's not willing to contribute that concession. Now I'm going to be on the hook to either renegotiate or just pay that out of my pocket, which could affect essentially affordability, right? Because if I'm already at the very top of what I qualify for, and now I have to bring another $25,000 down, that's not going to get wrapped in.
It can't get tied into the loan.
Unfortunately, there's not a way to tie that money to the loan. So that could put them in a situation that property may not be for them, unfortunately. So that we could, there's definitely going to be situations like that, I'd imagine.
Well, I don't know the data points, but we actually discussed this last week at this mastermind with other agents. Look, most agents, when they get their start in the industry, start focusing in areas where there are challenged listings, canceled listings,
foreclosures, NODs, and FSBOs, for sale by owner, right? For sale by owners take a longer time to sell, for a lot of different reasons, right? But I imagine we'll see something similar with these changes, which is if you have a seller that's not offering any concessions, it's going to be a stickier, more complicated transaction to get done. Ultimately, that house might sell for a lower number, especially if it sits on market for a long time. I mean, we're in the camp at Buy House. I mean, I'm happy to say it publicly. Like, I think a sophisticated, non-emotional seller will offer and try to make it as clear as possible because they want to cast a broad net, get all of the possible buyers and brokers to see the asset to get it to move quickly. Well, and I think it comes back to something that we've talked about quite a bit is agent education as well, because we're really setting the tone with our clients the same way we always would. So our clients, as a listing agent, our sellers rely on us to tell them, hey, what do you think makes the most sense in this situation? So, it's important for agents to be able to articulate what it could mean if you don't offer concessions. It is a possibility where they have to walk away from the home. It is a possibility where they just can't afford it. And so, depending on the pocket that you're in and the price point, I mean, it is a real thing. But education is key because at the end of the day, you want to get as many people to your home as possible.
Exactly.
And that message comes from us. The message starts with us. So making sure that we're providing accurate information to our clients, I think, is more important than ever.
Right.
Yeah.
Right, exactly.
But so on that note, I know that there are some guidelines about seller concessions. So if the seller is providing a concession for commission, how does that factor into the loan that you're providing?
So that was actually a huge win that they are allowing the seller to pay for the buyer agent and not be included in the percentage allowed of seller concession. What I mean by that is that, like, there's programs. So give an example, if they're going conventional financing and they're putting less than 10% or less down, they could only receive seller credit of 3%. And so if that buyer agent needs 2 or 3%, essentially they're already used up all their seller credits allowed. But what they passed is saying, hey, we're not going to include that formula in this. So any credits that are being received to pay the buyer agent will not be included. So this way the buyer needs additional credits such as closing costs, or they're receiving credits from lieu of repairs, or whatever the case is. They're like, no, we're tapped out. We're like, that's not the case. So to me, that's a huge win, because that's putting the buyer in a position where they could buy the home. It is an option for that seller to cover the buyer agent's fees.
Yeah. One of the other rumblings that I've heard is that the conforming loan limit by county is going to increase, which is an easy way for them to also massage that number to qualify.
Absolutely.
And we've seen that drastically over the last even 5 years, right? In Orange County, Southern California, I think a conforming loan limit in 2020 was like 770.
Yeah.
And today we're at like $1,050,000.
Yeah.
Or $1,060,000.
Yeah, exactly.
So that buyer can bring 3% down and qualify for $1,060,000, where 5 years ago it was 770.
That's actually a really good point. I could see that it's always going to continue to increase while the home values continue to increase, right? But I feel like what you're talking about, I think it's a good point that we could see that increasing essentially to cover those fees.
Yeah.
End of the day, I just feel like the housing market's so important for the economy that there's always going to be a fix. There's always going to be an adjustment. They're going to pivot one way or another.
I mean, it's kind of like that DREAM program that came out in California, right? It's like, okay, it's really difficult right now to afford homes. Like, we got something for you. So I do think
really
that there will be creative solutions in the future as all of this unfolds.
I would be remiss if I didn't ask. So obviously you guys are both wildly successful in your individual careers and as partners and everything. What about like your daily routine, or both of your daily routines? I don't know if I even asked you that before, Suzanne, but like what do you guys do that makes you so successful and so focused and driven to, create businesses and go down that entrepreneurial pathway?
I think what's good is that we're both on the same page. So, there are times where, for me, I think, where things are difficult for me, but I know that, I have support from him emotionally to, allow me the opportunity to focus on my business and vice versa. So I think, for us, having a real partnership and being able to, fill those gaps when maybe one is really, starting a new business and diving in and investing a lot of time and hours. I think, having that support from my partner, I think, really enables me to be successful. And I think, he would kind of say the same thing.
Yeah, absolutely.
That's the right answer.
No,
That's what she said.
She nailed it again. No, no, absolutely. I feel that, and then communication. I feel like communication is everything, because when she needs something, and then communicating what can I do to carry that for the rest of the day? What do we need to do, right, to adjust? So,
but having the same goals, I think, is really important too, and the same long-term vision. But I think both of us, just like you, wake up very early in the morning and get what we need done, and then the rest of the day is focused on how we can be better for our agents, for our loan officers, and for our business as a whole. And then of course making sure that we still have time to go to the Spain house too. That is definitely a thing. But
we normally ask guests about their most exciting and then their worst real estate experience. I think we're coming close on time, so we might have to invite you back. I'd be intrigued to hear if your worst and most exciting experience is similar to hers.
It's gonna be the same thing.
Probably.
There's no way you can top the Spain story.
We're gonna have
so stressful.
We're gonna have today was a lot more focused on rates and Streamline, but I'd love to hear more about that.
Yeah.
I'd also love to hear just more about like your general routine. I think a lot of our listeners, we get a lot of feedback about what is it that you guys do on a daily basis to enhance your focus and be focused on the business and create what you're doing, and so we'd love to hear about that on your side.
Part two.
I'd be happy.
Part two.
I'd be happy to come back.
Yeah, well, congratulations on your business. Thank you so much for the support you provide to us and for all the information.
Well, I appreciate you guys, and thanks for having me on.
All right, That is the end of the episode. Check back next week.
See ya.